mortgage insurance.
Some are better than others, and there are some big differences between the two.
I moved my mortgage. I'll go get the insurance again.
What if you're not insurable?
There you go. I really can't afford a $500,000 mortgage.
Insurance policy comes along and they want $500 a month for the purpose of a discussion.
Hi, folks, and welcome to the Mortgage Den. I'm Nick Da Silva here at Northwood Mortgage Limited. I am the principal broker, and today we have John Klotz from Northwood Financial. Welcome, John.
Thanks, Nick. Thanks for having me.
We're here to talk today about mortgage insurance. You hear that terminology all the time, and people get confused on what it really is. Define for me, what is mortgage insurance?
Well, we know what the CMHC insurance is for. That's to protect the loan, but this is the one you use to protect in the event you die or get sick or disabled, to protect your family.
So it protects the mortgage in case of, as you say, death or some kind of ailment that causes you unable to work or something along those lines. Who offers mortgage insurance?
Well, there's multiple ways to get mortgage insurance. In fact, the lenders offer it through creditor insurance. That's one avenue, and there's multiple creditor insurance products. Some are better than others, but the other way is to individual life insurance policies or disability critical illness policies as well. And there are some big differences between the two.
Now, let's talk about the creditor one. I mean, as you said, the banks or the lenders offer it. The mortgage brokers offer it. What's the difference between the ones that the mortgage brokers offer and the banks offer?
Typically, lending institutions offer a traditional creditor insurance product. It's owned, the owner would be the bank, and the beneficiary would be the bank as well. Same as with what's being offered by mortgage brokers. Some of the differences, though, with a lot of the lending institutions is the insurance is not portable. So if you start with one, if you have a mortgage with one institution and you move your mortgage to the other institution, they won't transfer it. And that becomes problematic in the event you want to redo your mortgage with another institution. However, some of the newer products offered by some of the creditor insurance does offer portability, and that's actually a really big improvement. However, at the end of the day, it's still a creditor insurance product, which means the individual doesn't own the policy and the beneficiary is the bank. If you want to ask me what a big deal is, I've been in the insurance business for over 30 years. I think I understand why people buy something like life insurance. And the reason is they buy it because they care about somebody. The beneficiary being the bank or the lending institution. My question to you is, do you care about the bank or do you care about your family? It's a good question to ask you, Nick.
It's a good question.
Yeah.
And I care about number one, which is me and my family.
Exactly. So I kind of don't understand that concept, why someone would, given the opportunity to own, say, an individual product where they get to name their family versus a product where the bank is the beneficiary. So I'm a big believer in sort of the more traditional type of insurance for a number of reasons. That being number one is you get to name the people you care about. The other thing is, too, and some of the differences between, say, creditor insurance and individual insurance is, and a perfect example is, Nick, I know when your kids were younger, they were involved in a lot of sports and things like that. So with the creditor insurance, let's say you have a mortgage of $500,000 for the purpose of a discussion. In the event you pass away, the mortgage gets paid off by the creditor insurance. But now, let's say the surviving spouse has two kids, say, in hockey or in various things. Now, in order to get money, they have to refinance the mortgage to take money out. Wouldn't it make more sense to say, here to my wife, I leave $500,000. She can pay down part of the mortgage, but she's got money left over to operate the family. No. I always thought that made more sense.
No, that makes more sense. But let's talk about creditor insurance for a second.
Sure.
I go to the bank, I get my mortgage.
Sure.
5 years later, I move my mortgage. What's the disadvantage? I mean, I just moved it to another institution. I'll go get the insurance again.
What if you're not insurable?
There you go.
And that's the big thing. So that's actually more the point with the portability is, what if you have a change of health? And we notice this all the time. In fact, at a certain point in your life, you can't take your health for granted. So for instance, you take out the mortgage at a certain age, and 5 years later, you're a diabetic, perhaps. So suddenly you're now applying for insurance, but you've had a change of health. Maybe they won't offer it to you, or maybe they'll offer it to you at a higher rate.
Right.
So the idea is, what you want to do is end up with a product that's portable from house to house, mortgage to mortgage, such that in the event you have a change of health, you're not going to be dealing with this circumstance.
The other part of it is I'm almost 5 years older at that point in time.
Yep.
Right?
And you're paying more.
Age make difference?
Yeah, sure. And now you're paying much for the product. The other thing is, with creditor insurance, and maybe this is the direction. Like let's compare your if we're talking about creditor insurance and sort of more traditional, there are some big differences. As I mentioned, one was the beneficiary. The other one that I find kind of interesting is you're paying a level premium for a declining balance. And I don't understand that. I don't know.
And so what does that mean? So, Johnny, I get hit by the proverbial beer truck 10 years into my mortgage. The mortgage started off at $500,000. What's getting paid off?
So what's getting paid off is it started at $500,000, but now it's down to $350,000. $350,000 is getting paid off. However, what you've been paying is a premium at $500,000.
So I don't get what I'm paying for.
Exactly.
All right. So what are my alternative outside of creditor insurance? I come to you and I say, hey, you know what? Let's compare to what creditor insurance is offering. What would you be recommending?
So firstly, there is nothing wrong with creditor insurance as long as you know what it is. You know, you don't get to name your beneficiary. It's part of a group plan. The rates can change. Technically, some may be portable, not portable. However, yes, there are other options to consider. So one would be a traditional insurance product, say a term insurance product with a 20 or perhaps 30-year period, which would cover off the length of the mortgage. You know, what the other thing, one of the other differences I find is the underwriting. Typically, and you were talking about your mortgage brokers offering insurance, typically the mortgage broker may offer the client to complete an insurance application for mortgage insurance, for credit insurance. The client has no idea what they're filling out. They're asking all sorts of questions. And the client may not be sure as to how to fill it out. Maybe they're not sure the sort of questions. Whereas with an individual insurance program, you're technically dealing with a licensed insurance agent who's going to ask you a multiple of questions. And I always feel with respect to these products that, you know, when you're applying for insurance, I always feel if you're not mildly annoyed by the process, you really haven't purchased insurance. They should ask you a bunch of nosy questions. Because one of the differences between these two products is, especially with lender institutions, is the underwriting is done at time of issue with traditional insurance. Whereas with creditor insurance, it's often done at time of claim. That's another big difference, which means that with a potentially creditor insurance product, if you make a claim, they are underwriting you at that time, asking you questions that they should have asked you initially when you took out the product. Right. That's a big difference with underwriting.
So I really don't know I have coverage until I'm dead, and then my family finds out after they start underwriting me.
Yeah.
Have you heard nightmares of that?
Yes. In fact, CBC Market Watch did a fabulous documentary, which you might have seen. And one of the questions they asked the client is, have you ever, on creditor insurance, have you ever been tested for high blood pressure? Now, Nick, you've been to the doctor, and they put the little wrap around you. The question is, actually, you have been tested for high blood pressure, but you don't have it.
No.
So that's a technicality. The insurer could come out on a creditor insurance product and say, you didn't disclose everything.
Or I didn't answer the question properly.
Didn't answer the question properly. We're wiping ourselves on the claim.
Even though I don't have high blood pressure, because I answered it incorrectly, they negate.
Exactly. And it's technically being underwritten at time of claim, whereas an individual policy will be underwritten right up front. They'll ask you those questions. And so that's a big deal. The other thing is, there is a 2-year incontestability clause on most insurance policies. So this is for the first 2 years. If you failed to disclose something that was significant, the insurer has the right to walk away from the policy offered on traditional coverage. However, with underwritten at time of claim, such as creditor insurance, that technically doesn't make sense. There is no incontestability period. It's ongoing.
You've been underwritten, you've been prodded, they've taken a pint of blood, and they've given you the green light to move forward.
Yes.
And you have coverage.
Yep.
I hate to ask this question. You know, spouse passes away. How does the other spouse make a claim?
With respect to insurance, obviously, in the event your spouse passes away, typically, spouse will have to complete a statement of claim and provide a death certificate. At that point, if the policy is less than 2 years old, the insurer has the right to examine the application to make sure it was accurate. If it's more than 2 years old, typically we're delivering a check in about a month.
John, you've been in the industry, as you said, 30 years. Yeah. Why do people need life insurance? I mean, we talked a little bit about it, but why do they need life insurance when they're taking out a mortgage?
Yeah. You know, that's the biggest, it's one of the biggest purchases people will make in their lifetime is their home, and they want to protect it. And you want to take care of your loved ones. And you can do it the most non-selfish president you can give your family is a life insurance policy, because it's not about you. It's about them. You're protecting them. At the same time, Nick, it's not just about life insurance. There are other products to consider. One of them is critical illness coverage. Critical illness coverage. Well, life insurance is pretty straightforward. In the event you die, pays a lump sum that you can use to pay off your mortgage, to help your family. Critical illness says it's a living benefit. In the event you develop cancer, heart disease, stroke, Parkinson's, MS, there's a list of 23 horrific specific diseases. In the event you develop these diseases, technically you can receive a lump sum that would pay off your mortgage. Average age of claim on critical illness, Nick, 41.
Wow, that's pretty young.
Yeah, and that's where we're seeing a lot of claims. And we've noticed that the majority of claims we pay are critical illness, and people are surviving.
Right.
The bad news is they're not surviving financially. They don't have critical illness coverage. So that's something to consider. Also, disability insurance is an important product. In the event you're unable to perform the duties of your job, you need money to continue paying your mortgage.
John, I've just gone and taken out a $500,000 mortgage.
Yeah.
Right? I got a big payment to make. I got to pay the taxes, got to pay the utilities, pay to live. I really can't afford a $500,000 mortgage.
Yeah.
Does creditor insurance provide the ability for me to take a smaller policy?
My understanding is yes. And also with traditional insurance, my understanding is yes, of course, you can take a smaller amount. And in fact, maybe that's the solution, Nick, for a lot of people need to face is, as you said, I have a $500,000 mortgage. I'm barely making my payments. I'm getting through the day. Now suddenly this, insurance policy comes along and they want $500 a month for the purpose of a discussion. I say, why don't I, instead of $500,000 mortgage, why don't I cover off a smaller amount? At least buying my spouse some breathing room. Right. I think that makes a lot of sense.
One other question for you. Let's look at costs. Yeah. Creditor insurance in the banks, credit insurance through mortgage brokers, which is usually Manulife and Sun Life, giving them a little bit of shout out. And I'm coming to you for, say, a 20-year term life. I know a lot of it's based on age, but in your opinion, who is the cheapest?
Technically, I think they're pretty close. I mean, a lot of them will be based on your age. They can come very close in terms of price. Slightly even less expensive. You can look at a term 10, which will come in less expensive than your traditional creditor insurance. But I don't think it's a price issue as far as value. I'll tell you what I like about creditor insurance, though, if you want to ask me, is there's an immediacy about it. You basically take out the creditor insurance, you've got the coverage in force. And there's a typically, especially on the Manulife product, there's a 60-day look where you can basically say, if I don't want this product, I can rescind it and get my premiums back. And that gives you an excellent window to maybe look at your other options. And that's what I know a lot of your brokers do. They give their clients this period to look at other options such as individual coverage.
Now, John, when I first came to you, I was a young man, family, kids very, very young. Yeah. As they grow, they have less needs. My spouse had less needs to have insurance. Would you recommend a term 10 and then take another term 10, even though the cost goes up, or would you recommend a term 20 for clients?
Yeah. So we get this a lot. So the typical client, when they're looking at insurance, most mortgages are 20, 25, 30 years. Typically, we find clients are taking a term 20 because, which means the rates stay fixed for 20 years, and then they jump dramatically. Term 10 is a relatively short period of time. So if you have a 4-year-old, at the end of your term 10, which is 10 years, your 4-year-old is now 14, still financially dependent on you, and yet your premiums jump. One of the other things that's interesting about term insurance is it's convertible under traditional insurance, not creditor insurance. So why does that become important, Nick? Why do you think that's important?
I would say as you're getting older, you're looking at estate planning.
So here's what happens. We end up with John, who's 35 years old. He's got a 20-year term. He turns to me at the age of 50. So he's 15 years into his coverage. And he said, you know what? I paid off a lot of my mortgage. I don't need this coverage. But what I'd like of this, say, $1 million policy that I bought from you is I'd like to take part of it and make it last forever. Now, with creditor insurance, he cannot convert that product to something permanent. With individual traditional coverage, he can. What this means is no underwriting. And even, let's say he's had a change of health in this 15 years. Doesn't matter. They took his information 15 years ago when he was, as you say, a young buck, healthy, and now suddenly he's 15 years older. He's now a diabetic. He's suffering from a bunch of other things. It doesn't matter. They can convert it at that age without going through any underwriting. And I always say to my clients, it's perfect. Those ads they have on TV, no medicals required, no obnoxious insurance agents will contact you. I said, well, only one obnoxious insurance agent will contact you, me. But other than that, it's transactional.
I'm looking to buy a house, right? I've gone and met with my lawyer, met with my real estate agent, met with my mortgage broker. I should be coming to meet with you as well.
I think so. Yeah, it makes sense to at least know your options. And to me, that's, there's a lot of information out there. You can buy products online. You can buy insurance products, investment products online. But really what you want to do is make an informed decision. And I find that's what people want. They want some clarity. And you're a mortgage broker. There's a ton of information about mortgages out there.
Yes.
And it's overwhelming. And so what people want is they want a solution. And I think it makes sense when you're looking at your options to discuss with someone, this is what we do. We help people through this sort of maze of information so they can make an informed decision. Even if at the end of the day it is creditor insurance, which, like I said, has some very intelligent benefits, that's fine, as long as it's an informed decision.
Well, John, that was really great information about mortgage insurance. I hope our audience really gets good use out of it. And it's Northwood Financial. I'm going to give John a little push there. And this is The Mortgage Den. Nick Da Silva signing out.